In a previous video, we calculated the positions and we changed it manually. In this video, we're going to try to change it automatically to have an automatic result. It's going to be useful to understand how we can adjust the algorithm, especially when we're calculating an efficient frontier, and we know how to adjust it a little bit so we can improve our algorithm a little bit. I need to raise the variance also to the power of 12 divided by 39. With 5 years of data, that would be 1 divided by 5. Forgot to do that in another video, but here we're calculating the average return value. So here we should calculate also the average yearly variance. It's not going to change much on the outcome percentage-wise with 20 stocks, but anyway, this is the only right way to do it. So we can take a look below at the few lines of extra code. I equaled the optimize data frame with allocation, so I didn't have to go and run all the code all over again if I made a mistake. I created a new column and I took the sum of the risk reward ratio. I took 1 and I divided it by the sum. So here I can multiply that by this result. So the result of this column is this column multiplied by the result of this calculation. So when we're going to take the sum of those stocks here, of those values, it's going to be 1, even with the negative values. The negative values will be short positions. In another video, I will disable short positions because short positions are very difficult to be profitable and not all brokers allow to go short. But for educational purposes, I wanted to show how you can calculate even with short positions. So if I will comment this data frame, it will give us an array with all the positions we have to fill in, and this array will be based on those values, and those 3 values will be negative. The reason why I don't change them to other stocks is because in a normal portfolio with 20 stocks, you will always have some stocks that are outperforming the market, you will have stocks that are very bad performers, and you will have stocks in the middle. So to stay realistic, I wanted to keep those bad performers in my portfolio. So I will comment the data frame and we'll take a look at our array. This we can copy and we can paste it above in the weights. So now we have an automatic calculation. This calculation will give the maximum results based on 3 years previous data. In the other video, I will disable short positions and we will keep a very small position in those bad performers. So we can copy and paste it in the weights. Then you can run it again. Those green lines, they're not important, they're things that I tried before, so we're going to run it. And the difference here, we have 107%. Here we had 46 in our low risk portfolio, and in our 5% allocation we had 68. So this is the maximum you can get from those 20 stocks. In theory, because in real life this will not be the case. So we will run that. I created a dictionary here because it's easier to work with a dictionary than to anytime wrap it into a data frame, especially when we are having multiple portfolios, and there's probably even an easier way. So we'll run the dictionary, and I set the dates to index. So below we will have the dates in our graph. And we'll plot the graph. And we have a very high return. It dwarfs the orange return, but we also have like 3 times more risk. If we take the low to the high and we take the low to the high, it's almost 3 times. And it's probably never going to be achievable, this kind of return. So in the next video, I will disable short positions and we will take a look at the difference